Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his Thursday expert and friend of the channel, Mr. Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. I missed you for a couple of weeks, but I'm glad to be back on the show. It's always one of the highlights of my week. So
I appreciate that. I enjoy having conversations with you. We go in so many amazing directions, and it's such a good time. And today is no different. We've got three vastly different discussions. The first one's going to be the Fed. The Fed and Jerome Powell came out with their 50 basis point move, which I called weeks ago. More importantly, we got clarity that the next two meetings, 50 basis points looks pretty certain.
Yeah.
And also we got, there's no consideration of 75, and they're going to be reducing their balance sheet starting June 1. So lots of stuff to talk about. Where do you want to go first?
Yeah, well, listen, I mean, I would have to say that these are all good moves and necessary moves, but that doesn't mean that it's going to be easy as a result, right? So the Fed reducing its balance sheet is something that I think is just really vital to do, given how much the balance sheet increased over the last few years. Like getting that back into some kind of normal range is going to be difficult, but I think it's really important. So I'm glad to see the Fed doing that. And interest rates, I mean, look, independently of inflation, having these ultra low interest rates, I don't think it's really healthy. Getting back into a normal range is good. Of course, they've been goaded into it by the inflation that they're in part responsible for by making money so cheap. So again, this is the right thing, but it's going to cause pain. I don't think there's any way around it.
Yeah, I think that is. It's just it's going to cause pain. We're already seeing some of the pain. Again, if you're directly impacted by this, obviously it's kind of that running joke, right? The difference between a depression and a recession. A depression is when you lose your job, and a recession is when your neighbor.
Yeah, exactly.
Yeah. So again, I don't say this with any disrespect to any individual who might be suffering already, but we're kind of on a scale of 1 to 10. I think the pain threshold, we're kind of like 2.5. We are at the beginning.
Yeah, I agree with that.
Right. If you're I put out a video yesterday, and I strongly believe this, that unfortunately, if you're in the mortgage industry, it is going to feel like the Great Depression. If you have real estate commissions as your income, it might feel like the Great Recession.
I think that will depend on where you are.
Sure.
And we can get to that in a minute, but I agree that this is going to cause some pain, just at they're taking the punch bowl away now, right? And so they've been liquoring us up with cheap booze
for too long,
years and years. Yeah. And now they're suddenly saying, oh, we're taking the punch bowl away, and now you're gonna have a hangover. And
or kind of withdrawals. Like it's probably even worse than a hangover. It's probably like a drug addict's withdrawal, right? Where you, at least how they're displayed, I personally have never seen it, thankfully. But as going cold turkey, as you see it in the TV shows, it doesn't look fun.
You're on the same age as me. When you were a kid, did they show you that cold turkey movie?
Oh yeah, they did.
Remember that?
Yes.
Yeah. What happens with withdrawal when the guys like puking up their gut?
The crazy thing they shared, teenagers, right?
That's
Nancy
right.
Reagan, don't do drugs.
Gen X, this is what we had to go through.
Exactly. Crazy stuff.
We had to watch actors pretending to be junkies, puking their guts up.
Yeah, it was fun.
But anyway,
I digress.
So the economy may be puking its guts up soon.
But again, we're at a 2. Yeah. And I already have people clamoring that the world is falling. Folks, it's a 2. I think we could go to 12.
I don't know. I don't know if it's going to get that.
Okay, let's talk about it.
I think there are a couple of, first of all, I think the pain is never evenly distributed. Right?
True. Very true. Yes.
You never have, even in the worst of times, you've got areas that continue to decline because of local factors. And even in the best of times, you have areas that are lagging behind. So that will continue no matter what. And for instance, talking with some, brokers that I know who are operating in very high income areas, like that, they're not going to see a lot of change, right? It may it may take out the marginal buyers who are stretching to buy,
Mhm.
but the Google employees who are flush with cash, like, are still going to be buying new apartments and new houses, and
Mhm.
they can afford, whatever the increase is. Maybe, they might not even be buying with a mortgage at all,
Yeah,
right?
they yeah,
So,
it doesn't matter. Yeah.
right, it may not matter to
Mhm.
some of them, and if it does matter, well, they're making enough money that they can absorb it, and
Mhm.
So for that end of the market, and in certain, you know, high end markets, I don't think that this is going to be the end of the world for any of these people, right?
Yeah.
So I think where it really is going to hurt is your first time buyers, your more
Mhm.
marginal buyers, people for whom a $100 or $200 increase in their mortgage payment is really going to hurt, right? And it's
Mhm.
going to just make it impossible for them to buy.
Yeah.
So I think that's where it's really going to hurt. And I think it also could hurt, uh, flippers, right? People
Oh, for
who
sure.
were, if you have underwritten your deal at a certain, expectation of, an exit, right? And interest rates cause that price to drop because you've got fewer buyers. Like, we could see some people exposed, especially if they're thinly
Mhm.
capitalized. And they can't, the guys who are just only flipping one house at a time and all their funds are tied up in that house. If you've got guys who are flipping, dozens of houses at a time, and have deep pockets, they may be okay. But if you've got guys who are like, all their savings are just in this one house.
Well, I want to warn flippers about one other thing, right?
Yeah,
Even if you get your number, I think you need to plan for an extra 60 or 90 days of hold time. Again, this punch bowl, this 2 years was fake. It's not normal. The speed at which stuff was going into escrow and closing is not normal. And some of them have built their models where they're not anticipating carrying cost. There's not enough carrying cost there. It's
yeah,
like, you got 2 more months, buddy, right? Yeah, minimum 2 more months. So I think there's all kinds of, I just think the last 2 years, a lot of bad habits were turned into best practices, and
yeah.
it's going to be bad.
I mean, what you typically see during the investment cycle, whether it's real estate or anything else, is more and more inexperienced people getting pulled into the market the longer it goes on, right?
Correct.
And also, ironically enough, the more risk averse people being pulled in, the longer it goes on, because they get lulled into a sense of safety, like,
Yeah.
by extraordinary performance. So the people who are sitting on the sidelines after the last crash, you know, those people eventually get pulled in sort of just before the next crash, because
Mhm.
they finally capitulate to
Yep.
the euphoria and feel safe enough to get in, and then they get in and they get burned. And
Yep.
so, and look, this has gone on for such a long time. Even the last 2 years aside, the last 10 years, and we have not seen any respite from the relentless increase in real estate prices. And everybody has just really internalized, like, this is going to go up forever. And like you said, a lot of bad habits have been developed. People have gotten bailed out by the market, right? And it is very easy to make money in a market that just keeps on going up and up and up and up. And I think
Mhm.
if you're not, I mean, I've been saying this for a couple of years, if you're not thinking about the potential downside, you are really putting yourself at risk for not just some nasty surprises, but I mean, for some real
Yeah.
hardship. So you have to be looking at your deals from the perspective of what needs to go wrong for me to lose money, and how likely do I think that is, given that we could be heading into a recession, right? And so you've got to be looking at, like, what is your break even occupancy, right? Where is that level of break even occupancy, and what's that? That's, you got to be, how likely do I think, if it's 73%, right? Well, that's a pretty good cushion. Probably not going to lose 27% of your tenants.
Mhm.
So you'd probably be okay. But if your break even is, 88, right? It it's not. It could
Yeah.
absolutely, your occupancy can get into the 80s.
Absolutely.
If it's a recession and you're not the nicest property on the block, right?
Yeah.
So
Yeah. Exactly.
it's it you got to be thinking about these things, and you got to be, really drilling down into what could go wrong.
Yeah.
You know, if you know what I mean, it's like too many people just focus on the upside.
Yeah.
And
Good times never last. Bad times never last. We are clearly entering winter. I would argue winter has started. You know, you got a couple of more days to prepare because it's going to get cold. This, it just, I hope this doesn't sound bad. I don't mean it to sound bad, but I'm ecstatic about the environment we're going into. I've been preparing for this for 9 months now. So I look forward to fishing, and I look forward to finding my motivated sellers. If I do 2, 3, 4 deals this year with motivated sellers, I'm going to be ecstatic. I haven't had a motivated seller in, God, years.
yeah,
So I'm ecstatic about what's coming. I won't be offering list price on nearly anything, which is, you know, something I've offered list price for far too long, right?
yeah,
The market's changing. I'm preparing for it. I will wait it out. I've raised capital on purpose for what's coming, and it's here now. And yeah, the pain has just started. If you're feeling it right now and it feels like a 9 or 10 for you, I'm sorry, because we have so much more to go through. It's just this will be a cycle. It will be quarters, and I would argue, you know, probably a year and a half before we may start to come out of this. I'm calling for a recession Q2, Q3 next year.
right.
So,
I mean, yeah, it's we'll see where it shakes out, but I think that's like certainly within the reasonable realm of possibility, right? So I know what the Fed is hoping. The Fed is hoping the economy is hot enough now that it can absorb
yeah,
higher interest rates and just sort of cool off without going cold. Like, I think that's the
yeah,
hope.
yeah.
We'll
Yesterday's quote of the day was softish.
soft. But it's definitely going to hurt real estate because, as we've talked about so many times, your cost of capital is what drives pricing. And you know, I keep on hearing like, oh, it's not going to happen because there's all this money on the sidelines. But you know what? We've said it before.
It will. Yeah.
Some of that money, listen, some of the money on the sidelines is sitting in the stock market, and it's going to go kablooey.
Yeah, it's already down 20 some odd percent.
When stock market prices decline.
Yeah.
Some of that money is going to get sucked off, you know, sucked into T-bills when T-bills suddenly are, you know,
They're 10 years, 3% again today. I checked this morning.
When you can get 3-4% on a T-bill, you know, and if interest rates are going to go even higher,
yep,
then that's going to suck a lot of money off the table, right? So, and it just makes the lending cost higher for the lenders. So that's, you know, that's another thing. So there just won't be as much liquidity in the market.
And the other thing I just want to say, because I've lived through this now twice, when the market goes bad, that money that you thought was solid gets scared,
right,
and it will stay in cash.
Right. Well, not just that. Some of it will get scared, but some of it is very sophisticated people who are looking at the market and saying, I think it's going to go lower. I'm waiting for my moment.
Yeah.
Right. So it's not like, oh, because we have money in the bank, we have to invest it in something.
Yeah. Fully invested.
I mean, we've had this discussion a lot in my coaching community, but you know, and I've argued with some people for years about this, even when it was like, you know, it even made less sense before, but if they're saying, oh, well, you know, inflation is 8%, do you want to be in cash? And, you know, sophisticated people are saying, I'm willing to lose 8% on this cash over the next year in order to buy an asset at 20 to 30% discount.
Every time. I make that trade every day.
Not just that, but if the money is in the asset now, it's going to lose that 20 to 30%. So not only, so having the money invested, and this is going to be the thought process of a lot of sophisticated people.
Yes.
Putting the money in now means that I'm going to not only miss the opportunity to buy when it's cheap, but I'm actually going to lose value during that time. Now, look, if you're locked into long-term financing and you have a long-term hold, long run doesn't matter to you, right? But for people who are like making the decision to buy right now, if it starts rolling and you start seeing some actual declines, you'll see the reverse of the process that we saw before, right? There was a positive feedback loop as prices went higher and higher and higher. What you'll see is a negative feedback loop drawing back in the other direction. The lower prices go, the lower people will expect them to go. We'll start waiting for bargains, right? And it'll have to get pretty cheap before, you know, some money starts to move. And the amount of money on the sidelines is not the determinative factor. The determinative factor is do the people who have that money on the sidelines feel like they're getting the best deal they can or not? You know, they're looking at making money. They're not looking at like, you know, oh, if I'm not invested, I'm a sucker, right?
Yeah.
So that's I think, so people have to, that's I think the counter argument to like, oh, there's so much money out there that it's just going to buoy the market no matter what, right?
Yeah, I totally agree. So as we kind of wrap up this episode 1, I think if I were to, you know, kind of put Jerome Powell in a box, I think he is the Fed president that is going to tell us what is coming and then deliver. I think he's now proven that a couple of times. So expect 50 bases the next 2 meetings, unless stuff gets really hot and they start talking about it. Because again, what happened after the last meeting, we had 8 Fed presidents come out and basically say, we need to go harder, we need to go faster, which they did. Exiting this meeting, they're like, okay, 2 more 50s are coming. But let's wait and see what happens. I think I did a 70-30 yesterday that we might get a 75% or 75 basis point move in July. This was pre-meeting, so I hadn't heard Powell speak yet. I'm going to stand by that. I still think there's a small chance that we get a 75 basis move. Productivity numbers this morning, biggest drop since 1947.
Wow.
The flip side of that is wages up 11.6%. So I think wage inflation is just getting to the white collar. And I think we have wage inflation in front of us. Jonathan, where can people find you?
Well, many places, but right now I'm in Brooklyn if you want to drop by. But seriously,
awesome.
You can find me on Facebook in the multifamily investment community. It's a free community where we talk about stuff. You can ask advice. There's 12,000 people in there who know what they're doing, most of them, or a lot of them anyway. So people are always happy to help you. You can go to my website if you would like to join the deals I'm working on. That is, just Google Two Bridges Asset Management, and you will find my website, and there's an investor page that you can fill out. That will get you on my list. And if you're interested in learning how to do multifamily investing your own, you can join my coaching group, and that is multifamilylaunchpad.org/join.
Awesome. Thanks, Jonathan.
Mm-hmm.